Hello, my brilliant friends, and welcome back to Boss Economics World, the only show that treats the global economy not as a science, but as the high-stakes, smoke-filled poker game it truly is. Today, September 4th, 2025, our dear friends at Goldman Sachs, the benevolent oracle of Wall Street, the paragons of selfless public service, have graced us with another one of their little prophecies. They've peered into their crystal ball, a sphere polished with the tears of retail investors, and have declared that gold could rally to nearly $5,000 an ounce. Now, a normal person might see this and think, wow, time to buy some shiny metal. A financial professional might nod sagely and say, a tail risk hedge against institutional decay. But you and I, we're not normal, are we? We're students of the game. So, we must ask the real question, is this a prediction or a prescription? Is Goldman Sachs playing weatherman, or are they seeding the clouds to make it rain? Let's dissect this golden onion, shall we? Because beneath the headline lies a story not just about a commodity, but about the slow, agonizing death of something far more valuable, trust. First, let's look at the numbers Goldman is throwing around. They're giving us a tasting menu of delicious panic. Their baseline forecast? A casual $4,000 an ounce by mid-2026. Their tail risk scenario? A spicier $4,500. And the main course, the grand finale? Nearly $5,000 an ounce, if, and this is the critical part, just 1% of the privately owned U.S. Treasury market were to flow into gold. Let's pause here. Do you understand the sheer magnitude of what they're suggesting? The U.S. Treasury market, as of our broadcast today in late 2025, is a behemoth, a leviathan of debt clocking in at around $38 trillion. Privately held debt constitutes a massive chunk of that. 1% of that market isn't pocket change. We are talking about a capital flight of $380 billion. Imagine a fire alarm goes off in the world's most crowded theater, the U.S. Treasury market, the supposed safest asset on earth. Goldman is pointing to a tiny emergency exit door labeled gold and whispering, if just 1% of the audience calmly walks through that door, the price of admission to the safe room will be $5,000. But here's the economist's dirty little secret they hide in the fine print, assuming everything else constant. My friends, in a crisis of this magnitude, nothing is constant. A 1% shift wouldn't be a calm, orderly cue. It would be a stampede. It would trigger a cascade of forced selling, margin calls, and systemic panic that would make 2008 look like a pleasant Sunday brunch. Goldman's $5,000 figure isn't the ceiling. In that scenario, it's the first step on a ladder to a number we dare not even print. They aren't just making a forecast. They are crafting a narrative. They are planting a seed of doubt in the minds of every bond fund manager, every pension trustee, every sovereign wealth fund on the planet. And that seed is, what if the full faith and credit of the United States government is no longer a credible guarantee? And why, you ask, would anyone doubt the mighty U.S. Treasury? This brings us to the heart of the matter, the catalyst for this entire golden fantasy, the Federal Reserve. The Goldman note explicitly says, and I quote, a scenario where Fed independence is damaged would likely lead to higher inflation and an erosion of the dollar's reserve currency status. For decades, the independence of the central bank has been the bedrock of the modern financial system. The Fed was supposed to be the stoic, non-political adult in the room, whose only job was to take away the punch bowl just as the party was getting good. Its credibility was built on the belief that it would inflict the necessary pain raising interest rates, slowing the economy, to crush inflation, regardless of who was in the White House. But look at the landscape of 2025. The national debt has ballooned to over 130% of GDP. The interest payments on this debt alone are projected to exceed our entire defense budget by next year. We've just come through a brutal period of sticky inflation in 2023 and 2024 that the Fed struggled to tame, with core CPI stubbornly hovering above 3.5%, eroding the wages and savings of every citizen. Into this powder keg walks the political pressure. The prompt mentions President Trump's recent move to oust Governor Lisa Cook. This isn't just a personnel change, it's a symbolic execution. It's a clear message sent from the political branch to the monetary one, you work for me. Your mandate is not stable prices, your mandate is my re-election. When a president, any president, believes they can bully the central bank into keeping interest rates artificially low to juice the stock market and make debt servicing cheaper, the game is over. The Fed transforms from an independent arbiter into a glorified printing press for the Treasury. This is not a hypothetical. This is the well-trodden path to ruin we have seen in the Weimar Republic, in modern Argentina, in Zimbabwe. It is the absolute, textbook definition of fiscal dominance, where the government's need to finance its deficits overrules the central bank's duty to control inflation. Goldman knows this. They are looking at the political theater, they are looking at the mountain of debt, and they are saying, the institutional trust is cracking. And when trust in paper promises, in fiat currency, begins to crumble, where does capital flee? To the one asset that has no counterparty risk, that cannot be printed into oblivion, that has been a store of value for 5,000 years. Gold isn't just a hedge against inflation, it's a hedge against irresponsible politicians. Now, let's zoom out from Washington and look at the global chessboard. The erosion of Fed credibility isn't just a domestic issue. It's an accelerant poured onto the already raging fire of global de-dollarization. For 80 years, the world has run on the US dollar. It has been the premier reserve currency, the medium for international trade, the bedrock of global finance. This exorbitant privilege has allowed the United States to run massive deficits and fund its lifestyle by selling its debt to the rest of the world. But our competitors and adversaries are not blind. They've watched the US weaponize the dollar through sanctions against Russia, Iran, and others. They've watched our national debt spiral out of control. And they are taking action. Look at the data. It's not a conspiracy theory, it's an undeniable trend. According to the World Gold Council's latest figures for Q2 2025, central banks have continued their historic buying spree, adding another 250 metric tons to their reserves. Who are the buyers? The People's Bank of China, which has now reported 32 consecutive months of gold purchases. The Reserve Bank of India. The central banks of Turkey, Poland, Singapore. This is a coordinated, strategic pivot away from US treasuries. Let's look at the IMF's COFR data on currency composition of official foreign exchange reserves. At the turn of the century, the US dollar accounted for over 71% of global reserves. As of the latest data available to us in 2025, that number has plummeted to a precarious 57%, and the trend is accelerating. The BRICS Plus bloc, now expanded to include major energy producers like Saudi Arabia and the UAE, is no longer just a talking shop. Their Project M-Bridge, the multi-central bank digital currency platform, is now in advanced pilot stages, successfully settling cross-border trades in local currencies, completely bypassing the SWIFT system and the US dollar. Do you see the feedback loop? The US government pressures the Fed to keep rates low, damaging its credibility. Global central banks see this, fear future inflation and currency debasement, and accelerate their diversification out of US treasuries and into gold. This reduces foreign demand for US debt, forcing the Fed to print even more money to monetize the deficit, quantitative easing infinity, which further debases the dollar. A weaker dollar makes imports more expensive for Americans, driving domestic inflation even higher. This leads to more political pressure on the Fed, and the vicious cycle repeats, spinning faster and faster. Goldman's $5,000 price target isn't the cause of this crisis. It is a symptom. It is a fever reading on a very, very sick patient, the post-Bretton Woods, dollar-centric global financial system. So, what does this high-level geopolitical drama mean for you, the professional fund manager, or you, the regular person just trying to save for retirement? For my professional audience, the traditional 60-40 stock/bond portfolio is fundamentally broken in this environment. Why? Because its entire premise rests on the negative correlation between stocks and bonds. When inflation is the primary driver of risk, and the credibility of the bond issuer itself is in question, stocks and bonds fall together. US treasuries are no longer the risk-free asset, they are becoming the source of the risk. Gold, in this context, is not just an asset. It is a vote of no confidence. It is an insurance policy against systemic failure. The question you must ask is not what is my allocation to gold, but rather, what is my exposure to the decay of institutional trust? For the everyday investor and citizen, this is not an academic exercise. The erosion of the dollar's reserve currency status is a fancy way of saying that the value of your savings, your salary, and your pension is being systematically and deliberately destroyed. The persistent inflation we've seen is not a bug, it is a feature. It is the only way for a government this indebted to deleverage, by paying back its debts with devalued currency. It is a stealth tax, a digital pickpocketing of your wealth. When Goldman Sachs publishes a note like this, they are not just analyzing the market, they are signaling to the elite that the rules of the game are changing. They are telling their clients that the store of value function of government bonds is failing, and a great rotation is beginning. They are catalyzing the very fear they are describing. So, will gold hit $5,000? My friends, that is entirely the wrong question. It's a distraction, a shiny object to fixate on while the real story unfolds. The real question is this: when gold hits $5,000, what will that $5,000 be able to buy? What will be the price of a gallon of gas? A loaf of bread? A new home? The price of gold is not rising in a vacuum. It is a mirror, reflecting the collapsing value of the paper currencies it is priced in. A $5,000 price for gold is not a sign of gold's strength, it is an indictment of the dollar's weakness. It is the cost of broken promises, of fiscal profligacy, and of the fatal erosion of institutional trust. The Goldman Sachs note isn't a research report. It's a flare, fired into the night sky, signaling that the ship of state is taking on water. And in a storm like that, everyone starts looking for a lifeboat. Right now, that lifeboat is made of gold. Think about it. Until next time, stay sharp, stay solvent, and trust no one, especially not the ones printing the money. Ciao.